right. Well, welcome everyone. We're very happy to welcome you to our webinar on Rethinking Emerging Markets, the driver of global growth. This is hosted by the CFA Society of Minnesota. And we'd like to say a special thank you to our annual sponsors. These annual sponsors help us bring many programming and events to the Society, CFA Society of Minnesota. We couldn't do this work without them, and I know some of you might be represented here today on the call, so we thank you for that. And I do want to let you know we are recording this, and we will make it available after the webinar. So it's my pleasure today to introduce Kevin Carter, who's the founder and CIO of EMQQ Global, and he'll tell you a little bit more about himself. Welcome, Kevin.
Thank you, everyone, and thanks for tuning in. I'm going to get my slides up here first. So I'm going to go fast. I'm going to cover a lot of ground today. I'm going to tell you about myself, how I got involved with emerging markets and what I did before that. I'll tell you everything that I've learned, at least the two most important things that I think you need to know about investing in emerging markets. And then I'll tell you how we approach emerging markets and why we think it's not just the best way to invest in emerging markets, but perhaps the best way to invest in growth generally on the planet over the next couple decades. So just in terms of my background, I'm going to tell you the details, but as I go through my presentation, you're going to hear me refer to three different versions of what I do and what my business does today. I invest in emerging and frontier markets, all 46 of those countries, and I invest in the internet companies. The EMQQ, which is our, the name of our company and our flagship, that includes all emerging markets, China being the largest. If I talk about FMQQ, that's the same, but without China. And finally, INQQ is just the India version, but it's all about emerging and frontier markets, internet companies, just a couple of smaller subsets when I get into the meat of the presentation. So in terms of myself and how I got here, I live about 15 miles east of San Francisco. I've lived here my whole life, other than a few years off at college. And when I returned here in 1992, I had one interview at a company called Robertson Stephens and Company in downtown San Francisco, which was the leading technology-focused investment bank at the time. And my interview was 20 minutes long. We talked about college basketball for most of that 20 minutes. And then I was told that I could start working there on Monday. And my immediate response was, well, how can I possibly start Monday? I don't know anything about investing. And the person said, well, go buy this book, and wrote down A Random Walk Down Wall Street. Now, I suspect that at least half of you know this book and have read this book probably. It was first written 50 years ago. And you may know that it's written by a guy named Burt Malkiel, who's a Princeton economist. And it's widely thought of as the book that helped to launch indexing as a strategy and efficient markets as an idea. In fact, in the first edition, written in 1972, the author suggested on page 226 that somebody should make an index fund. There were no index funds back then. There were a few people talking about it, and it was Burt Malkiel who wrote that indeed somebody should make a fund and to make it a not-for-profit. And if the New York Stock Exchange didn't do it, somebody else should. A couple of years later, John Bogle, in fact, did just that. So this book and this person are long part of the world of indexing. This gentleman, Burt Malkiel, was also the chairman of the committee that created the first ETF, the SPDR. So that's how I started my career. But I'm an Omaha person. When it comes to investing, when it comes to business, I think and look through glasses that are Omaha, Berkshire Hathaway, Warren Buffett, Charlie Munger style. But for the last 25 years, I've been partners with this guy. First, with my own new investment instrument idea, the a business I started in 1999 called e-investing, was the first fractional share brokerage, so allowing people to buy stocks in dollar amounts instead of share amounts. You may remember back then, if you wanted to invest in the stock market, to get the cheapest commission, which was the $29 Schwab commission, you had to buy 100 shares of a stock. The average stock price was $30. So if you wanted to invest in the stock market without going through a mutual fund, you had to have $3,000 for one stock to get the $29 commission. And most people just didn't have that amount for a single stock. So people were stuck with smaller dollar amounts going into mutual funds. And so we created a system and filed a patent on the process by which people could trade stocks in dollar amounts. We sold that to E-Trade in the year 2000. Burton was an advisor to this company. After that, we invented this other thing called, we called it active indexing. It's been rebranded as direct indexing, but this is something we started in 2002. Burton as the chief investment officer. We sold it to Natixis at the end of 2004. Now, some of you probably know what direct indexing is. I won't go too far into it, but basically you build your own custom index portfolio in a separate account and use, particularly for a taxable investor, you just do regular loss harvesting to create tax losses, which have value, and you can then, quote unquote, beat the market. So we sold this company in 2004 to Natixis, a big mutual fund company in Boston. But just before we sold the company, Google went public. And when they went public, they had an investor planning day for their employees. They had two guest speakers. One of them was Bill Sharp. The other was my partner, Burton. And I wasn't invited to that talk, but I had dinner with Burton the night before. And a few months later, I got a phone call from a person at Google, and that person asked me about investing. He said, I heard about this direct indexing and I want to make my own custom S&P 500 portfolio. How do I invest with you? And I said, well, you'll need an advisor at Credit Suisse or Deutsche Bank or Morgan Stanley, which were the three places where we were approved. And he said, well, I don't want an advisor at one of those places. I want to invest in the strategy straight directly with you. And I agreed to meet with him. So I drove down to Mountain View, and one thing led to another. And he talked me into basically becoming his advisor as a side job, and then started introducing me to other people there at Google. So all of a sudden in 2005, I'm the CEO of an investment management division of Natixis, but I'm also serving as an advisor and building portfolios for a handful of people at Google. And while I'm doing that in 2005, Burton starts going to China. And he ends up writing a white paper. Two of his Princeton economist friends were Chinese economists that had gone back at around the year 2000 to teach economics in Beijing. And he was convinced to come visit and see the economic miracle that was unfolding in China. And they wrote a white paper about it. And the people at Google found out and called me and asked if Burton could come down to Mountain View and give a talk about China. So that was about 18 years ago. We drove down. Burton gave his talk. And when he was done, all of these people looked at me and said, we want to invest in China. So this was not planned, but somehow from the moment that talk ended until today, my entire life has become devoted to figuring out what on earth does that mean to invest in China and then in emerging markets more broadly. So now let me tell you what I learned in that period. First, just to set the stage about, what exactly are emerging markets? Where are they? Which ones matter the most? Where's the opportunity? Basically, there's 46 emerging and frontier markets. The frontier markets are supposed to be sort of the junior emerging markets, but let me say that when we get into indexing and databases and emerging markets, there's a lot of stuff that doesn't really add up or look as clean as you'd think it should. But either way, there's 46 countries. And in terms of the size of this, and when I say size, I'm talking about the population size, I'm talking about the GDP size and also the stock market value. This is 60% an Asia story, with China being the biggest part of that. It's about 15% over here in Latin America, with Brazil being the biggest part. And then there's 25% that's scattered all over the place, from South Africa, Morocco, Egypt, Turkey, Kazakhstan in the middle there in gold. So that's what it looks like on the map. And the reason that this asset class is important, even though it hasn't really performed well for investors, is because this really is where the opportunity is for growth. This is where 85% of the world's people are. They're actually a bit younger than we are. So it's about 95% of the young people. And when you really take the whole story apart, it's the people themselves that are emerging. You have billions of people, and they're moving on up, and they want stuff. They want more and better food. They want more and better clothing. They want appliances. They want vacations and to go to movies. They want a motorized vehicle, and they want their kids to go to Harvard. And that's the story. I didn't have to figure this out. It was very well documented when I showed up. And you can see on the bottom of this slide that McKinsey, in fact, calls it not just a big opportunity, but the biggest growth opportunity ever. Now, maybe they're wrong, and it's the second biggest or third biggest opportunity. But if you're going to invest in emerging markets, this is what you should be focused on. This is what I've been focused on for 18 years, and it's the foundation of everything that we do at my firm. So we'll come back to that. Now, let me tell you the only other big thing to know, and this is something that I learned in the first 5 minutes after Burton's talk 18 years ago. So after Burton's talk, we drove back to San Francisco. We went up to our office. I walked directly over to our portfolio managers, and I said to them, please give me a list of all of the companies in the FXI. Some of you may know what the FXI is. That's a ticker symbol for the first and only China ETF that was available back then. It was the FTSE Xinhua China ETF from iShares. It still trades, and it was the only ETF available. And I assumed that's what we would use for these people at Google that wanted to, quote unquote, invest in China. But because I'm an Omaha person, I don't care what the name of the ETF is. I want to see what are the businesses that we're going to become owners of. So I asked for the list. Before they gave me the list, Burton pulled me aside and explained to me that almost all of the companies in the China index were Chinese government-owned banks and oil companies. Now, for perhaps obvious reasons, that didn't sound great. But then he went on to give me an example of how a Chinese state-owned bank would make loans to companies that were basically bankrupt to avoid having layoffs. And that made me somewhat nauseous inside, because in Omaha, investing is really simple. The reason that any company has value is because it generates profits for the people that own the company. And if the people that run the company don't care about doing that, why on earth would you invest in them at all? Now, the China ETF back then was 80% state-owned enterprises and less than 10% in consumer stocks. The broad emerging market indexes aren't as bad. They're about 30%. And you can see what this means for investors. So this is showing you the return of the FXI over the last 15 years. And you can see that indeed the Chinese economy did boom. It's up 400% in that 15-year period, quite a bit more over the 18-year period with the miracle of, or the 8-year period with the miracle of compounding. But look at the return of the index or the ETF. You lost half of your money. So this is the problem in emerging markets. And if you want to make money, you have to evolve and get more targeted in how you do that. So in my first 8 years in emerging markets, primarily focused on China, I launched with Burton and Guggenheim a number of China ETFs that Invesco later acquired. But I spent most of my time in New York and Boston with a few dozen different family offices, foundations, endowments, and I watched what they were doing with their EM allocations. They were increasing the size. You can see Harvard's basically doubled in that period. But as they got bigger and they saw the problems with, the traditional approach or the index, they decide they need to get more targeted in this concept of emerging markets 3.0. And if you were David Swenson managing the Yale endowment, well, you had a lot more choices than the average person. You could take your smartest Chinese alumni, for example, and start a private equity fund, as they did, which worked extremely well. But most people couldn't start their own private equity fund. So when people would ask me, what's the best emerging markets ETF, I would tell them that the answer was really simple. You just want to buy the emerging market consumer ETF. There's a ticker symbol, ECON, for an ETF that does just that. I didn't make that ETF. I didn't know anybody that was involved, but I knew it existed. And if you just wanted to buy that slide, you wanted to buy the 30 largest emerging market consumer stocks, according to Dow Jones Index, then that's what you should buy. And it owned the food and clothing companies, the Walmart of Mexico, the beer companies here and there. So that's what I told people to buy. And then it was about 8 years ago, or no, rather, it was a little over probably 9.5 years ago, I got a phone call one morning and a friend asked me that very question. What's the best emerging markets ETF? I started to tell her to buy the emerging market consumer ETF, but then I had a light bulb moment and I realized that that wasn't the answer anymore. And the reason was that the advent of the smartphone in particular had made the best consumer stocks technology stocks. And so the things that were growing the most in terms of consumption were put in the database, not as consumption companies. So let me tell you, though, what the story is, because I didn't realize it as clearly then as I do now. But there's basically three things happening on the planet at the same time. Three mega trends. We call it the Great Confluence, which is just a fancy way of calling it a mashup. But it's a mashup of three big one-directional cellular trends that I've been part of, my family, for generations, probably yours as well. So what are these three mega trends sweeping the planet? This is the first one. We already covered it. My family had plenty of food, clothing, vacations when I was a child. My brothers and I, the first ones to go to college, but our country, for the most part, has been in consumption mode for multiple generations now. Most of the world's just getting involved, and this is where all the people are. Now, when my friend called me that day, I answered her call on my iPhone, which was sitting next to me. So I had a smartphone back then, but it was pretty new, and I could already see how it was changing my family's consumption. The trips to the Target store were declining, and all of a sudden I knew the UPS driver by name. Well, the reality is, though, that I had a computer for 20 years before I got a smartphone. So the second megatrend in the story here is that the computer is reaching the world for the first time. And it is not a desktop computer, and it does not have an Apple logo. It's an increasingly affordable Android-based smartphone. Now, if I gave this talk to your chapter 5 months ago, I would have told you on this slide that you could buy a brand new smartphone in India for $50. And that's still true, except on July 3rd, a $12 brand new smartphone was introduced, the Geo Bharat. So the computer is the second part of the story. It's reaching millions of new consumers a month in India alone, getting their first computer. And it's bringing the third megatrend with it, which is called the internet. I first accessed the internet in 1995 in San Francisco's Marina District on a telephone line with a modem. So I've had the internet for, I guess, 30 years now. Well, guess what? Most of the world never got wired. So not only do you have billions of new consumers getting their first computer, but they're getting connected for the first time. And to even make this a bigger deal, they don't have the consumption infrastructure we have. And so they're leapfrogging all the way to the cutting edge. And most importantly, this is on the finances, the financial services. People don't have a credit card or a debit card. And so it's the mobile-based payments that are the first step in this, leading the way. But they don't have automobiles, they don't have Target stores. And so again, they're leapfrogging and in many ways are more digital than us. And it's driving this story on this slide. Ultimately, this is the reason I created EMQQ and our other versions. It is a story of incredible growth. Now, when I gave my first CFA presentation in 2014, I only had these first few bars here ending in 2013, and I offered the audience a ham sandwich if they could show me a sector that ever grew like that. Now I have a $100,000 reward. If you could show me a sector that ever experienced this type of growth for this length of time, I will give you $100,000. Now, I've asked everybody I know if they can, if they know any sectors that might have done this before. I've asked Burton, who's been teaching economics for 60 years in the Ivy League, and he doesn't have any ideas. So again, I'm not positive, but either way, this is a massive amount of fundamental growth. And what goes with that, value creation. Now, you can see here in gold how the emerging markets internet companies have done over that same time frame, and they're up a few 100% versus 7% for the MSCI index. Now, obviously, there's a major correction or crash that has occurred in part of this slide near its ending, and so we've had a major correction, but nonetheless, long-term investors have done a lot better in the internet sector. And I would also point out, as I will again, that most of the internet stocks in the emerging markets, they're not even included in the MSCI index. So if you use iShares or Vanguard types of approaches, you don't even own most of the internet companies. Now, China has driven the story. I'm sure you all know Alibaba. You probably have heard of Tencent. These are the super apps of China, and you can call them technology companies, but what they did was digitize the entire consumption experience in China, from healthcare to entertainment to food and groceries. Alibaba's Hema market, pictured here, will probably IPO. It looks like Whole Foods, but when the lunchtime and dinner time come, this place turns into the Jetsons. And finally, Alibaba and Tencent have the money on the phone, and it all starts with payments. And once you get the payments and the money on the phone, well, then you can provide all of the rest of the financial services people need. That includes selling them stocks and ETFs, selling them insurance, making loans to them. Imagine if everybody in the United States had their checking account at Amazon and also bought their ETFs at Amazon and got their car loan at Amazon. That's the way this looks in China with Alibaba and Tencent, and it looks more and more like this all over the world. You get the money on the phone. They never had a bank account, and once you get the money on the phone, you're in business, and it's happening all over the planet that way. So now there's a lot of other big Chinese internet companies that some of you probably know, but let's talk about the rest of the story, because China is the biggest emerging market. It's going to be that for a long, long time. And it's going to be an emerging market for a long time, at least according to the broad indexes. But if we were going to recategorize the world by e-commerce, by smartphones, by digitization, China's the most developed country on the planet by a mile. It's not even close. You can see here, not only is China's e-commerce market way bigger than ours, it's 4 times bigger than every other emerging market combined. So China is very much different than India, Brazil, Nigeria, et cetera, when it comes to e-commerce. And it's been the biggest part of our broad universe. Again, we have FMQQ, which is the ex-China version of this universe. But you can see that, 60% of the story, 60% of our portfolio or index has been in China. But look at the fundamentals. It's been 80% of the revenue. This is the same revenue I showed you earlier. This time, China's revenues in gold, the other 45 emerging markets, the third wave or FMQQ or whatever you want to call it, the ex-China in purple has only been about 20% of this. But look at this. The ex-China countries, the FMQQ countries, they have 4 times as many people as China. And while China's e-commerce penetration is 25%, the other 45 emerging markets are at 5. So you've got 4 times as many people in the first inning. And so I don't know how long it's going to take, but I will bet you a ham sandwich that purple revenue is going to grow 10-fold and probably 20-fold. And my only anecdotal research is that I've never known anybody that used to have a smartphone, and there's 3 billion more people in the other emerging markets that are getting their first computer today and tomorrow and the next day. So 3 billion more consumers coming to the smartphone world. So if you want to think about this in terms of the time that this has transpired, this third wave was preceded by 2 previous waves. And when I say a wave, what I'm talking about are the following. Millions of people that have personal computers. When did that first happen? And when could they use that computer at their home or apartment? They could turn on that computer and they could connect it via cable, a wire to the internet. And then they could turn on the computer and open a browser and go to a website and actually buy something or sell something, e-commerce. That basically started in the year 2000, right? Now, I had the internet in 1995, but let's say for simplicity's sake that started in the United States in the year 2000. And what happened? A 15-year S-curve as the FANG stocks took over our lives and our stock market. First on PCs, then on smartphones. The second wave was China, 2005 to 2020. You saw the numbers on that. And now there's a third wave happening. And the biggest part of that, and a lot of my focus over the last year and at the end of this presentation, is going to be on India and South Asia. This is where the third wave is coming right now. And the biggest part is South Asia, but it's already happening. It's happening in other regions. Latin America is one of the most developed parts of the story. Mercado Libre, some of you may know this company. This is really an important company in the foundation of EMQQ. I was watching these internet companies, explode in terms of growth in China, and all of a sudden this company came public, and someone sent me the prospectus 15 years ago, and I looked at the income statement and I said, oh my goodness, it looks exactly like a Chinese internet company on paper, fast growth, big margins. And I want to use this company, Mercado Libre, to make some points about this entire universe of companies. So let me start with the title of the slide. You'll see that this company is in Uruguay, and you'll see at the end there, the ticker MELI is on the NASDAQ. So most of these companies, especially the China and Latin American companies, have gone public in the United States. And so they trade on our exchanges. And a lot of times the country that they are headquartered in does not match where they get their revenue. So the database sees this as a company in Uruguay. The reality is that the income statement says it's a Brazil company and a Mexico company. So this company is the e-commerce and payments leader in all of Latin America, no matter where the database puts it. In terms of its foundation, this is also important. The smartest kid, and this is true for, as I'll show you, for the majority of our holdings, but the story of the founding usually goes like this. The smartest kid from every country goes to Harvard or Stanford. Now, I went to the University of Arizona. I had a 2.0 grade point average, so I'm not an academic snob. So if I offend anybody by using Harvard or Stanford, speaking very generically. But the smartest kid from every country goes to a good college like Harvard or Stanford. Founder of Mercado Libre, founders call them the smartest kids from Buenos Aires. They got their MBAs at Stanford in 1999. They graduated. They wrote the business plan for Mercado Libre, the Amazon.com of South America. They wrote the business plan in the library at Stanford. And when they graduated, the speaker at the commencement was a venture capitalist, and they were able to get some time with him and pitch him on their plan, and he funded them. And so, and what has ended up happening is because of this capital formation process, it doesn't guarantee perfect corporate governance, but I think it, compared to things like Petrobras in Brazil, where corruption is rampant, I think you can expect very good corporate governance from these companies. And the third element I'd like to just highlight here is that every one of these companies that's a success is creating an ecosystem and a miracle of compounding, a virtuous cycle. Every successful company is creating dozens or hundreds of new angel investors, new founders. And this is happening in Bogota, Colombia. It's happening in Dhaka, Bangladesh. I've been to these places. I've seen this. There is an ecosystem everywhere, and it's thriving. And to further that point, this is the second largest internet company in Latin America, Nubank. This is a company that's in Brazil. Most of its business is in Brazil, but it's also in Mexico and a lot of other Latin markets. The founder, David Velez, with the purple card, we'll call him the smartest kid from Bogota, goes to Stanford, works as an analyst at Morgan Stanley, goes back to Stanford for his MBA, goes to work for Sequoia, the venture fund that invests for Ivy League endowments. He gets stationed down in Latin America and tries to open a bank account in Brazil, and he cannot believe how difficult it is. He decides he needs to start an online bank, joins forces with this woman, Cristina Junqueira from Sao Paulo, who went to Northwestern and worked at Boston Consulting Group. They got funded by, initially, two of the founders of Mercado Libre and their firm Cossack Ventures. And then before their IPO, the last private round they did was with my heroes in Omaha, Berkshire Hathaway. So these are two examples of this story in Latin America. And let me also point out, neither of these companies are in the index. If you own the Vanguard or iShares version of emerging markets, your two biggest holdings in Latin America are both Petrobras, the corrupt oil giant, two different listings. You don't own two of the most innovative, fastest growing entrepreneurial companies on the planet, Mercado Libre and Nubank. But Southeast Asia is another part of the story. Again, this is Korea's e-commerce leader. You can see the list of institutions their founders went to school at. Same story in Korea, Coupang, trading on the New York Stock Exchange. Even Kazakhstan has a super app that's actually one of our most profitable companies trading in London. So, but let me move to India, because this is an area that, again, I've devoted almost the entirety of the past 12 months to the India story. And let me tell you why that is. So in terms of the EMQQ world, we've been waiting for India. You can see when we launched, we had 2 Indian holdings, and we only had 3 years ago. And the total weight of those Indian holdings in our primary EMQQ index, 0.5%. So 60% China, 0.5% India. But I knew there was a big pipeline of unicorns that were likely going to IPO. And so I had planned my inaugural trip to India for the spring of 2020 in anticipation of those IPOs, but I was kept away from India by the plague. But I finally was able to get there. And so I want to share with you a lot of my findings, but just to give you an idea of what's gone on in terms of India's internet market cap. We went from 0.5% to 12% in the broad universe. And of course, the other versions of the story have even higher weights. Some of the companies that, just to give you a feel, most of these companies are trading in India on the BSE or the NSE or both. A couple of them, the early ones, did go public here. Make My Trip, the travel app. This is InfoEdge, which initially traded here but moved to be listed in India. This was the Craigslist of China, the best way to think about it. Jobs, a big part of that, but online ads, and they parlayed those the cash flows from those businesses to invest in a couple of the other publicly traded companies as venture investors. IndiaMart, B2B, e-commerce, Zomato, this is the DoorDash of India. But I would also stress to you that, we use these examples like the DoorDash or the Uber, the Uber of this or the DoorDash of that. And, that's a good, quick way to think about it. But in India in particular, the opportunity set is so green fields for some of these things that you really have a significantly bigger opportunity. Consider that, in the United States, we had an extremely well-developed restaurant industry long before the smartphone showed up and food delivery. Well, India doesn't have that so much. And so not only is Zomato, helping to build the food delivery business, it's also helping to build the entirety of the restaurant business, including supplying the restaurants themselves, the way Cisco does, SYSCO here in the United States. Online beauty, online insurance, online gaming, all the basics, including payments. Now, this is a company that I will talk about a little bit more as I get to the end here. This is the payments leader in India, Paytm. It's been in my presentation for 8 years, but it's only been public for 2 years. The reason I featured it is because my heroes in Omaha made a venture capital investment in the company about 8 years ago. And as I mentioned, we didn't have a lot to talk about with India. We only had a couple of companies. And so we kept talking about the oasis off in the distance. And but it finally went public 2 years ago. Now, there's been a major correction, as I showed you earlier, in this entire universe. It hasn't just been the Chinese companies. In fact, the Indian companies, the Indian internet companies, all had a huge crash, including this company down about 80% from its IPO price. Also, Alibaba, an early investor. So I finally got to go to India, and let me tell you what I learned. First, I'm going to give you a super fast version of the history of India that I thought was important to understand. And I will stress it really is important to understand the chaotic, turbulent, and violent history of India over the last several hundred years. So, and I'm going to start with what was happening before the British came to India. So, before the British arrived, the Mughal Empire was the most thriving, or at least the second most thriving place on the planet, neck and neck with China. You can see that spread from Pakistan all the way through to the east. And it was actually a very well-run place. The Mughals were very good at assimilating all of the various groups and operated a pretty tight operation, and were incredibly wealthy. Their wealth was legendary. The word Mughal has morphed into an English word, and it was wealth and opulence was legendary, and accounted for about 25% of global GDP. The British showed up to trade. They were a little late in the global trading game. The Spanish and Portuguese and Dutch had started to make some real money for themselves, and the British wanted to try to catch up. It started relatively peacefully. They talked to the Mughal, who let them set up a fort and a port on the water. And then it got really ugly, and they ended up, this is a publicly traded private company that essentially bribed their way and otherwise looted the entire country. And it involved their own private army of more than 250,000 soldiers, Indian soldiers, fighting for the British East India Company, which was operated from a single office in London, but controlled all of this entire part of the world. And then it started to get ugly. The army mutinied. The British crown took over from the British East India Company. That didn't help much. And finally, the British decided it was time they got out of the country. And this didn't help either. The way they did this was hasty and really a disaster. And again, I will stress, this is important in understanding this part of the world, and it's, I think, particularly important in understanding some of the risk, because the separating India into three different pieces of land, West Pakistan, East Pakistan, and India itself, this was brutal, and the hatred and anger and suffering that came with this remains defining in this whole part of the country, including the tensions with Pakistan and to a lesser extent with Bangladesh. But Bangladesh didn't get free until 1971. And so as of that date, this is what it looks like on the map. Pakistan up to the west, Bangladesh surrounded by India down in the east. So that's how it came to be what it is today. And here's what happened to their share of the world's economy. So the British, the second word after mogul to remember is loot. The Mughals had a lot of money, and the British came, and you could argue there was the very significant looting that transpired. So, all right, where are we today with India? So India, once it got free in 1947, had to shake off its socialist roots, which took several decades. Now, today, the story looks incredibly compelling. On paper, I think you could say India is the perfect emerging market. Why? It's got the biggest population on the planet. It passed China. You can see it's going to get bigger and bigger than China. It's a very densely populated country, which is important. Notice the bottom, Bangladesh is the most densely populated piece of land on the planet. 170 million people, the size of Illinois. Unlike China, which is somewhat homogenous, incredible diversity. There's hundreds, in fact, over 1,000 languages spoken. The government publishes everything in 24 different languages. So again, unlike the homogenous population of China, very, very diverse in South Asia. It's young, so it's big, it's young. It's got the fastest growing major economy. The growth is coming in the middle class, just as we saw in China. In fact, it will pass China within a decade by most estimates to be the biggest consumption market on the planet. Smartphone penetration, as we discussed, still pretty low. It has the fastest growing e-commerce market. And finally, and this is important, more important than I realized, the Indian government, which is a democracy and in a very tense geopolitical world, a democracy that's in a pretty unique place, but it is also a friend to digitization, and I will show you that it, I think, unleashed an incredible set of programs that these logos at the bottom, which I've had in my presentation for years, but I didn't really follow these programs. I'm going to tell you about them, but they are very important to this India story. So why is this India story so good now? Yes, it's got all of those basics, big, young, fast growing, but it's also got some stuff that nobody else has. But all of it needed a good, physical foundation. And one of the problems that India had, when I got involved with China 18 years ago, China and India were neck and neck in terms of GDP. But you can see that China was building the world's best infrastructure. Well, India sat on its hands, and the power grid didn't even work, and you had brownouts and so forth. Well, over the last decade, under Modi's leadership, India has gotten their act together, and he's running the country like a business. He's got a huge approval rating. That doesn't mean everyone loves him. And again, I'll stress the religious and historic tensions between the different religious groups. but as a risk part of the story. But the majority Hindu love him. He's finishing his second 5-year term. He will almost certainly get a third 5-year term next spring. The infrastructure spending in the last 10 years, they basically doubled what they had spent in the previous 65 years. And it's showing up. It's showing up in the rail system getting modernized. The British left them an extensive rail system, which is valuable, but they've got to electrify it and modernize it. They're doing that. They're making their own high-speed trains. Hundreds of new high-speed trains will roll out of the factories in the coming few years. They're connecting the cities with the high-speed trains. This looks just like Shanghai 17 years ago. The airports are going to boom. They're already strained. They're going to triple the number of airports. One of the first luxury spends of an emerging market consumer is to take an airplane vacation somewhere within their own country. The seaports are getting built, and you're going to need those if you're going to get jobs from China. And India is and will continue to get a lot of manufacturing jobs as people look to diversify their supply chains. And that's all good and fine, but they're going to have to catch up on the actual port capacity if they're going to ever displace China in a meaningful way. So now, one thing that India has that no other emerging market has, or even developed market perhaps, is a 50-year-old technology ecosystem. So, you know, India's had publicly traded technology companies for 30 years, including Infosys and Tata. Infosys, the original India startup. These are publicly traded, employ tens of thousands of technologists and have billionaire founders. They have 23 Indian institutes of technology, which many think rival our best colleges. And they also have about 2/3 of the work visas in Silicon Valley go to Indian technologists. In fact, the CEOs of both Google and Microsoft came over originally on temporary work visas. Now, here's the secret thing that I stressed earlier that I think is really important to understand about India. I didn't understand this, so this is why I'm pretty sure most people don't understand this, but it's this digital public infrastructure, or India Stack. It's a series of programs that are interoperable and have created this digital foundation that I think is unlike anything the planet has ever seen. And I think it's quite powerful. And so I think one of the reasons that I probably didn't understand it better is that it was very abstract to me what this digital public infrastructure is. But the best way to think of it is, other examples of digital public infrastructure. The internet is digital public infrastructure that you probably use every day. Another version of digital public infrastructure you probably use is GPS. So when we talk about these programs, this India Stack, think about those types of things. They help answer important questions like, where am I, for example. So this is the hero of the story. This is Nanda Nilekani. He is the person that has overseen this digital public infrastructure. He's one of the founders of Infosys. He's also currently the chairman of Infosys. And the way this started was in 2009, the government wanted to build a national identity card system, because back then, one of the big detriments or things that were holding India back was that nobody had formal identification. Less than 10% of the people had a formal government-issued identity card, and less than half of the babies were even reported. And so you had a lot of difficulty in modernizing the economy. And so after many years of discussing it, they decided to launch a national identity card system where everybody would get a physical card with their own unique 12-digit number. And they asked Mr. Nilekani if he would be the chairman of this organization and the program called Aadhaar. Aadhaar means literally foundation. And he agreed to lead this, but he insisted that they use a lot of technology, and that included attaching every single 12-digit number to a human being's eyeballs and fingerprint scans. So biometric verification of each person. Now, it was totally voluntary, and you didn't have to sign up. Now, another part of this that I didn't follow, I don't remember hearing about it, was that 3 years after they launched this database, they added a layer to the stack. So the AutoHar database, then you've got Know Your Customer layer, and they opened a program with the banks that said if you are registered in AutoHar, walk into a bank, you can open a bank account with your eyeballs and a fingerprint scan in a matter of minutes. Again, I had that logo in my presentation. I didn't follow this. There's now basically everybody in the country is in the database with biometric information, and they've used this platform to open 800 million digital bank accounts. So you've now got financial inclusion happening at an incredible rate. And then in 2016, the big bang. What happened in 2016? First, Geo launched the first 4G network. Everybody else at the time was on 2G, and the carriers had been in a price war and not even investing in 3G. Reliance Jio spent $25 billion to build out the first 4G network, and they roll it out in November of that year. And it was a big bang in a number of ways. One of the ways was it was one of the first aha moments in terms of the power of this AutoHar and KYC layer. When they launched Geo, they used the AutoHar platform to sign up people for new phones, and they were able to sign up 100 million people that way in about 4 months. Now, before that, the average time about 5 minutes for those 100 million new subscribers. Before the AutoHar system, it took 3.5 hours for someone to get a new phone. So again, the big bang bringing 4G coverage to India. Now you can see that about almost 500 million people in India are on Reliance Jio. Cost of data in India has plummeted. We pay 50 times as much for our data. And then also in 2016, the Unified Payments Interface was introduced. This is another logo that I put in my presentation. And the headline of this, the description was, it's a free, simple way to instantly transfer money from one person to another or a person to a merchant. Again, it got a lot of hype. I heard about it. We put the logo on the slide, but we didn't really follow it. Well, here's what is happening now. So starting in 2016, you can see that this digital part of the story, the digital payments part, has exploded, and it shows no sign of that slope declining. And India now accounts for about 1/2 of all instant money transfers on the planet. And so not only is this exploding, but the entire economy has gone from cash to digital in basically 8 years. Look back in 2016, then 95% of the economy was paper-based cash transactions, and nobody paid their taxes. Today, 76% are of all transactions are digital. People are paying their taxes. They also simplified the tax code and took some of the large denomination bills out of circulation. So this platform they built, in many ways, I think, is just getting started. And one of the things that they've added recently, the most recent layer of the stack, the ONDC, is designed to work with this part of the Indian economy. So right now, the mom and pop Kirana store, kind of like a bodega in New York, 150, 200 items. This is where 95% of all, 90% of all retail spending happens today, is in these 13 million mom and pops. And I think what's going to happen, and what this new program is seeking to do, is to help digitize these store owners into a hyper local e-commerce. It's already happening. Paytm, you can see their logo here. Paytm has become the kind of go-to financial service provider for the mom and pop store owners. And actually, its main focus right now is growing its lending business to help stimulate further the growth of the Indian market. So this ONDC platform is the newest layer of the stack, and it's meant to help bring all of these players together on a, well, as it's described, an open network for digital commerce. So we'll see how this plays out. Either way, the Indian economy is likely to almost double by the end of the decade, but the Indian internet economy is expected to grow almost 500% in that period. So India does look like China 15 years ago in a lot of ways. As I mentioned, the GDP numbers were pretty similar, especially 18 years ago when I got involved. But importantly, nobody on the planet had a smartphone 15 years ago. Anecdotally, Apple opened its first store in Beijing 15 years ago this past July. And a month after I left India, they opened the first 2 stores in India. And now one thing that China didn't have 15 years ago is a $12 supercomputer. So this digital story in India, when I say it's the perfect emerging market, it's also happening at this sort of time where the arc of consumer technology has made the pocket-sized supercomputer essentially ubiquitous. So in summary, what I have told you is a story of growth happening in emerging markets. It's explained by these 3 different mega trends: billions of consumers in emerging markets, computers in form of smartphones, internet connections via wireless broadband and Wi-Fi, a lack of traditional consumption infrastructure, and a leapfrogging, explaining the strong growth. Side benefit in a part of the world where corporate governance is your biggest problem. You actually get companies that have had a pretty rigorous capital formation, including investors like Berkshire Hathaway in a handful of them. So on a relative basis to other emerging market indexes, I think you could expect exceptional corporate governance. And finally, there's a lot of people that don't like China for any number of reasons. I think most of the things people are afraid of with China are overstated. But either way, the third wave of this story beyond China is where the fastest growth is going to be coming in the next 2 decades. And India in particular looks like its own unique and very powerful opportunity. So valuations, we did have a pretty massive correction. There's a lot of concern still around the Chinese internet companies and just China in general. The PEG ratio for EMQQ right now is the lowest I can remember it being. It may have been this low once before, or I think it was, but right now a PE of 18 with 28% earnings growth expected for the year. And the PEG ratios for the ex-China version and the India-only version also, I think, look pretty reasonable. So that's the end of my presentation. And I will, if there are any questions, I can stay on here for a little bit if people want to put them in the Q&A box. But otherwise, I'll leave it up to the moderators if they would like to move on or do the Q&A.